In public markets, you've seen some spread widening.
Yes.
Nothing crazy, but it's there. In private markets, in public markets, you saw the widening. In private markets, you gave me an amazing statistic that you're seeing some funds being sold 90 cents on the dollar, as little as 70 cents on the dollar. And you told me that this is before the tariff negotiations started.
That's correct. In fact, I probably misquoted the low end. I think it's even lower than that in some cases. We've seen and done trades at, in the 50-cent range. So what I would say is this: if you look at all the major asset classes that we focus on, we're primarily sub-investment grade. It's high yield leveraged loans, it's private credit, and triple Bs. We occasionally look at triple Bs as well. High yield is about 385 basis points over right now. It got as low as 260. It's got as high as 460. So it's right in the middle of its range. Loans is wider of that. Those would imply we're at a very normal state in the credit markets, which I find ironic because this is anything but normal. These are unprecedented economic times. So as you look, I think it is starting to create some desire on the part of large institutional credit holders to get out of this before maybe there's something, before a fall. And that's where you're getting the credit secondaries. They've been pushing their GPs to get liquidity out of the funds. The GPs haven't done it at the pace that they would like. And now the LPs are taking matters into their own hands and putting credit secondaries out there for folks like us.
That gives me shivers to think about that.
Yeah.
The 50 cents on the dollar funds are being sold right now. And again, we have not potentially even seen the worst of this economy yet. What does it say about potentially problems that are being masked in private markets, given that we're not seeing daily marks on these types of assets?
Yeah, so I think what it says is, to date, we haven't seen forced selling. There haven't been really dire liquidity situations that people need to address. And so these have been mostly trades of convenience where they're trying to clean up a portfolio that they have. I think we're going to get into more sort of anxious points in time where LPs will want to trade. And I think those discounts will go out further. And they don't, again, those occurred at points in time where there wasn't a lot of credit impairment going on. If we see some of the economic weakness that I believe could happen, you will start to see impairments pick up. And then the discounts will be very large.